All right, all right, all right. Oh, my goodness sakes. Already starting off with some drinks. How do you like my mug? Look at this. I got this for Christmas. I think that's pretty awesome. All right. Somebody sent me that. Said you need a new mug for doing your videos. So they sent me a new mug. How's that? That's pretty good. All right. So how's everybody doing? Y'all have a good holiday? Seems like forever since we got back together and talked on the YouTubes. So I guess we need a lot of catching up to do. The last time we talked about doing some liquidating some positions for tax harvesting. And so I want to start there, and then I want to move into what we're going to carry over into 2026. And I'm still not exactly sure if that's what I want to do. I'm going to tell you one of my frustrations. One of my frustrations is that in this dilly-willy that we're doing here with these high yield funds, a lot of what we get back is what we call ROC, right? Return of cash, and then of course ROCC, which is return of cash and capital. So they give us some of our own money back. They actually do that. And the reason they do that is it's a strategic thing. What they're trying to do is they're trying to give you a consistent income for one thing. So if the markets go down, what happens is you don't make any money. All right. You don't make money because the markets went down. And I've always said in the yield max funds in particular, when the markets go down, you lose money. I mean, we always start off with every class with a big disclaimer that says you can lose money doing this. So what they do is they try to cover those losses for you by selling covered calls, right? That's what yield max does. Of course, there's granite shares. It's a little bit different strategy, but basically the same concept. So they sell some covered calls up there. So they are actually making money. So they're making some premium. They're collecting that premium. And then if the market falls and the premium doesn't cover the loss, they give you some of your own money back so that it basically is considered break even, right? I mean, they can't cover the whole loss, so they try with the dividends. Or with the, I don't like to call them dividends because they're not dividends. They're selling options premium, so they're collecting premium. And so let's say the market goes down $1,000, but they only make $900 in options premium. So what they do is they pull $100 out of your account to cover the loss. Now it's not exactly one for one, and that's not it's not a perfect world, but that's what they're kind of doing. So they're trying to keep it so that you have a consistent income each month. And so what you're supposed to do, the idea or the concept behind this when they first got started was, well, let's give these guys an income that they can rely on. And so if you need $10,000 every month to live, that's what you need $100,000 to live every month or every year. Then they're going to give you roughly $10,000 a month, and you're going to set up your portfolio so that it returns to you $10,000 a month. And they know that that's the kind of the concept. Okay. Maybe some of you don't need $10,000. You'll need a couple $1,000s. That's okay. They'll set it up to do that too. You can set it up however you want. A lot of guys don't need $100,000 a year to live in retirement or to live off of. Maybe you got other sources of income. Maybe you're still working. You'd just like to have an extra $1,000 a month. Well, you put your money into these yield max funds, and then what they do is they do their best to try and return that dollar amount for you that they're promising. And if they fall short of doing that because the market falls and they lose money, or your stock that you're investing in loses money, Tesla goes down or whatever, well, they're selling covered calls to make them the premium. But if they can't cover your nut, what you need for that month, they pull it out of your account and give you your own money back. All right. Which is what you would have to do if you were trading the underlying stock, right? So if you're trading the underlying stock and you need to make your house payment, well, you're going to take money out of the market. Well, they do it. They don't actually take money out of the market. They give you back some of your own money so that you're not actually losing shares. All right. So it's called ROCC. And when they do that, well, you needed $2,000, you needed $5,000 this month to cover your basis. So they give you $5,000. 4,000 of that was profit. 1,000 of that was just your own money coming back to you, like you would have done anyway if you were needing that kind of money. And that's the concept. So that's how these things were structured for an income source. People can live off of them, and that's a good thing. I mean, if you just let's say you have $1 million in your pocket, in your back pocket. Well, you can take roughly $50,000 out for the next 20 years, right? And you'd be fine. $50,000 for the next 20 years, and you'd have $50,000 a year. No growth because it's just sitting in your back pocket. But that $1 million would last for 20 years, taking $50,000 a year out. So you can. That's the concept of investing, trading, and that's what some of these concepts are built upon with these yield max funds. They're designed for income. All right. If you're young and you're trading and you don't need income, I'm not going to say you shouldn't trade these. You should probably still have some of these in your portfolio because they do have a high return, and they do, they can return a high return. We've experienced that this year. You can see my portfolio. Let me just pull it up here real quick. I've got it up right there. You can see my portfolio. I started, now this number right here started like 2 months before the year. But this is my total for the year. And so this is what I've got holding right now. I held a whole bunch of these things. I when I first doing this, I didn't know what I was doing very well. I was just buying them and selling them and buying them and selling them. I wasn't really I was just trying to, I don't know. I'm kind of want to go back to doing that. We just have lots of different strategies we can do with these things. And I'm trying to figure out what's the best with you guys. I wish I knew all the answers. I don't. I'm 1 or 2 lessons ahead of you in the Sunday school lesson manual. All right. I've been doing this for 40 years, and these are new. They've only been around for a couple of years. So we're trying to figure out what the very best way to trade these things is. But this is how I traded them this year. These are my results trading these yield max funds this year. Now I've traded the Granite share funds very, very little. I didn't trade a lot of those. I like them because they trade trade put options, and I like trading put options. So I'm going to try in 2026 to change things up a little bit, see if we can't do better. But you can see that this is how much I've got invested, 662,000 total invested into these funds. And these are the ones that I have currently holding because I sold a bunch. And so I took them out of my spreadsheet and took that money and either did something with it or I put it back in. All right. So the idea is to generate income. And so when you generate income, to circle back around to my original statement, you have to pay taxes on money that you make that you pull out of the market. And we have to think about that when we trade like this because it's income. Now, you don't have to pay taxes on the money that they give you back that's your own money. Now, here's the dilemma that I'm running into right now. I don't know how much they gave me back in my own money. I know how much they gave me. They gave me $450,000. I don't know how much of that was considered ROC or ROCC. Yeah, no, ROC, return of capital. I like to do it the other way around. I like to call it ROCC, cash and capital, because the cash that they give you is the distributions. That's the dividends. So they give you the dividends. Those you have to pay taxes on because that's like taking money out of the market, right? So you're like, well, I'm just going to reinvest it again. Well, it doesn't matter what you do with it. You still have to pay taxes on it if you're going to take it out. So that leads us to the idea of that, well, why am I going to pay taxes on it? Why am I taking it out if I'm just going to put it right back in? Maybe we shouldn't be investing our entire nut. And of course I don't, I have other accounts, but either one, you should be doing it in an account that's not taxable, right? An IRA or some sort of a 401k or something, so that you're not taxed on that money. Or you shouldn't be putting it in these funds. Maybe you should just be putting it into the underlying stock. So if you think Palantir is a great stock, and you don't want to, and you're not going to you have no intention of pulling it out this year, you just put it in Palantir. And then if you don't pull it out, you don't have to pay tax on it. But because they keep giving you money, because you put your money in there and they trade options on it and they take that money out and give it to you, well, it becomes income. And then you have to pay taxes on it. So what we're doing is we're doing some tax loss harvesting. So we have some drawdowns. And the problem is, let's say, go back to our little example. If they give us $10,000 and 9,000 of it is cash that we earned from our distributions, and then they give us an extra $1,000 to cover our expenses that we said we needed to have. Well, that $1,000 is capital, which we're pulling out, but we don't have to pay taxes on that. The problem I'm running into is I cannot find anywhere where they tell us how much is cash and how much is capital. They're not telling us what our ROC is. Now, when I check with my brokerage firms, neither one of the brokerage firms that I have these funds in are telling me the breakdown of cash and capital. They don't break that down until after after the fact. Kirk saying he's got his in an IRA that avoids taxes. Yeah, I've got that too. I've got an IRA where I've got another $250,000 in there. See, I started this one out with 476, but this is a capital account. So I have to pay taxes on this one. And it's a bigger account than the other one. The other one, my IRA is 250,000, and I don't have to pay tax on that. So I'm not worried about that one. So I agree with you, Kirk. I don't think, I mean, that's not the problem that we're running into with that one. So this is only a problem if you're in a taxable account. So I don't know, the struggle I'm running into is I can't find out, and I'm going to do some more research. I'm going to contact YieldMax and find out how we find out how much is capital, how much is cash and capital, because you don't have to pay tax. And so why is that important? Well, it's important because we want to do our tax loss harvesting. So we want to offset that amount of money. So if they gave us back, I mean, if we have, let's say we made $10,000, but 1,000 of it is return of capital, we only have to pay taxes on 9,000, not on 10,000. Now, they give us a report that comes out sometime in January that tells us, all right, it'll come out and you get a little report, a little 1099 that you run over to your tax account and you hand it to him, and he'll put that all in for you, or you do it yourself, however you want to do it. But it's just all lined out right there on your little 1099, and it'll tell you which is cash and capital. I want to know that before I get that 1099 because I want to do my tax loss harvesting, because you only get $3,000 to go over you only get to write off $3,000 of losses on your taxes. That's all you get to write off. So if you go over your cash and capital, you have to, how can I give you this example? The way this works is let's say you made 10,000, but 9,000 of it was cash, was profit, and 1,000 of it was not. Well, you can only write off your 9,000 or you can only write off your $1,000 of losses, right? You get to write off your $1,000 loss. But if you made money, it's got to balance out. You've got losses that you can collect against your profits. So we get a whole bunch of yield in here. See this? I got $131,000 in profit on yield. This is my dividends. And then over here, this is my net asset value, which is down 100,000. So I've actually made 31,000 right in here, in the what's left right here on these funds. So the total yield is 242,000 plus my profit. Okay, so now I've got. If you come up here, you can see I started with 476,000, and I took cash withdrawal 112,000. So my trading profit over here is 290,000. That's what I did this year for a 61% annualized return on this account. I think that's pretty good. I'm pretty happy with that. But the problem is I don't know how much of that is cash and how much of that is capital. And I'm going to have to pay taxes on all of the cash that they gave me, not on the capital. So if I got $1,000, let's say 50%, just to make it easy numbers. If I made $50,000 and $25,000 was profit and $25,000 was returning my own capital, which they don't really return very much, but it's enough to make you worried, right? You want to try and be the problem with me is I'm like an engineer. I want everything to work out and down to the penny. A lot of guys will round these numbers off to zeros, and that pisses me off. I want that 79 cents accounted for. So I have a little bit of a problem with that. But I want my cash and capital because I want my losses to offset my capital, my gains exactly to zero if I can. And then I don't want to include my ROCC, my return of capital, even though I know they don't return very much, but they do. They can still give you some. So I want to know what that is before January so that I can offset my losses right down to the penny. Because if you offset more losses than gains, you can only write off $3,000. So you can write off 100% of all of your losses if you had of 100% of all your gains if you had 100% of your losses. Now I didn't have nearly that, but I want to get as close as I can. And that would mean that I would have to come down here and sell all of these. See this? I could sell all of these because the NAV on these is down 100,000. And that would take another 100,000 off of my 290,000. But that yield is 242,000. So my NAV plus my yield is 131,000. So I got 242,000 in yield, but I got 111,000 in drawdowns for $131,000 in profit. I don't know how much of that is ROC. I don't know how much of that is my own capital that they gave me back. Now, I know it's not very much because I've seen my last 1099 wasn't very big. They don't give you very much back, but they do. They can still give you some back. And so I don't want to go over, because if I go over 3,000, let's say I write off 6,000, and I only needed 3,000. Well, that means that only get 3,000 this year in taxes, and the next 3,000 goes out into next year, because you can only write off more than what you lost. If you lose $100,000 in the stock market, you don't get to write all that off against your taxes. You know, you can only write 3,000 of it off. Now you can match your gains. If you had $100,000 in gains and you had $100,000 in losses, well, then you have no taxes, right? And you don't get to write anything else off because those two match. But it's the overage that is $3,000. So if you write off $106,000, but you only had $100,000 in losses, now you have $6,000 that you can write off on your taxes, because that's all you can do. But you can only do 3,000 this year and 3,000 next year. But then you got a whole nother year to deal with. So that 3,000, I'm just trying to save that amount of money. I don't want to pay that. I don't want to have more to write off than I need to this year. That's my point. Because you can only write $3,000 off over and above your matching break even. Right? Does that make sense? Ask Grok. He can explain it much better than I can. That's how it works. So that's what I'm struggling with right now. So I wish that I knew what my ROC, my return of capital, was to me before I go into the year end, and I don't. So I've got it taken down to, I've sold off a whole bunch of stuff. So my taxes should be very small, but I don't know, because I just don't know that number. And that's a frustration to me. And I'm still working on it. So if I find out any more information, I will let you know. Because right now, the only two stocks that I'm losing money on are this one here, which is HOY, HOOY, which I'm not hurting on that one, because I got one dividend coming in tonight, right? And it'll probably cover that. Well, no, it won't, because it's a weekly. The 1 month will cover that easy. And the same with this one, DG. These are some that I got in relatively recently. I got into GDXY, I don't know, about a month ago. And so I've only received, I got into the 1st of December, and I've only received one dividend, some small dividends off. I don't have very much money in there, 25,000. But these are the ones that I'm carrying. I'm thinking of carrying into, see, we've still got this week. What's today? Today's the 29th. So we got 2 more days after today to decide which ones of these we're going to liquidate. But that's another thing I wanted to talk about today too. So if let's say we liquidate all these, well, we can't get back into them for 30 days, right? We can't get back into them for 30 days. Now there's going to be a lot of people doing their tax loss harvesting this week. So there's going to be a lot of people selling out. They've been selling out a little bit. If you go look at the stock market, the problem is the stock market's been going up during the month of December. Now, if you go and read Pitt News Magazine, we wrote about this December month, and it's a little crazy, all right, because everybody's making a lot of money. October, this is AMD. Let's just go look at Tesla for fun. So, that's Tesla. Yeah, there we go. Okay, so this is Tesla. So everybody, on general, I mean, Apple, Amazon, Netflix, not Netflix, but Netflix too. Apple, Amazon, I've got some options on this one. Don't worry about those options. That was another lesson I was teaching. So let's hide all on-screen options for now. All right, so this is Apple. All right, so Apple made a lot of money this quarter. The market went straight up. People are now they have to, if they've been taking profits along the way, right? If they're just hanging on to them, they don't have to liquidate. But there's a lot of people who are doing tax loss harvesting right now in the month of December, right? So tax loss harvesting, that's why December is going down right in here. It's part of the pressure that's pushing this market down. Now there's also just, you can see the nice distribution on this thing. Man alive, this thing is following like a train on rails, isn't it? So this is what we're looking at right here. This is our map. So this thing went through the accumulation stage right here, right through the accumulation stage. It broke higher right there above that. And then we got our 3-drive pattern. 1, 2, 3. Yeah, almost, you want to count that one down in the accumulation stage. The breakout was right there. So that's almost like 4 drives. It's really 3 drives right up in there. This is your little head and shoulders formation, your little topping pattern right up in here. Look at that. Beautiful. Just like this little topping pattern. And I think we're going to get the little ABC pattern coming back down off the other side. And it should come back down into this red line right here. This is the 200 period moving average. I don't know. It might come down to there, but I kind of doubt it. It might. Never know, right? That's the whole idea. But you're going to get your little ABC pattern coming down off this top. And so a lot of this is the pressure from people doing their tax loss harvesting. And so they're selling out some of their positions to cover their losses on other markets. And so they do the tax loss harvesting on their winners, right? They sell off, they take some profits off the winners to cover the losses. So then they sell out their losers and roll money into their winners, or vice versa. And then this ends up pulling this market back down. So that's why we get oftentimes a drawdown in December, because people are tax loss harvesting, getting ready for tax season. I think we're going to see this back down at least to this red line. I don't know where this is going to end up right in here. I think it's going to break those blue lights. It might not. It might just keep coming down. We'll break the blue lights out here a little bit further. But I think we're going to get back down into this region here. Take our Fibonacci ruler and draw off the top to the bottom. That would bring us right back down dead center, that red line right there. So that's the Fibonacci sweet spot. And so I think people are going to start buying up down in here. This is going to be that map system that we just looked at, right? The Wyckoff strategy. And these big funds, especially the Magnificent Seven, they follow this Wyckoff accumulation distribution model like a train on rails. So that's what I think is happening here. So you got a lot of selling going on. And the problem is that once you sell out of it, you can't get back into it. You can't put your money back in for 30 days. That's the rule. It's called the wash rule. If you take your money out, you say, oh, I just harvested my losses, and now tomorrow I'll just put them right back in. And they don't let you do that. The little dirty bastards there. They come in and they say, no, if you're going to do that, if you're going to tax loss harvest, you have to leave your money out for 30 days. Now you can take that money and go put it in something else, but if you put it back into the same stock, then they're going to say, no, that's not a tax loss harvest. So you have to stay out for 30 days, which is why January oftentimes is kind of a funny market, because people will tax loss harvest all through the month of December, depending on when they sit down and do their tax loss harvesting, figure it out, right? So they're doing tax loss harvesting throughout the month of December, usually towards the end. But some will do it towards the first of some will do it in November, right? But then they want to start putting that money back in, putting it back to work. So they start putting it back in January. And that's oftentimes why we see January becoming a big month. But it's not all at once. It's not like, oh, January 1st is here, let's put all our money back in. No, it can't do that, because you have to stay out for 30 days. So depending on when you tax loss harvested and when these big firms, really it's the big firms, right? Those are the ones that are moving the market. The little small speculators, they don't, believe it or not, they don't do a whole lot of tax loss harvesting, because they just don't. It's the big firms that are doing the tax loss harvesting, and they have to stay out for 30 days, and then they can peel their money off and put it in other places to pick it back into those funds that they took the money out. They have to stay out for 30 days. And so that's why markets flush down. And then in January, February, we have big rallies in the first quarter. That's why the first quarter of a new year is usually pretty strong, because it's the money that's been taken out that's being put back in. All right, so that's where we sit right here. I think we're going to see a little bit of a drawdown. So if you're interested in Apple, this would give you an opportunity to put some money in Apple. I don't have any money in Apple. I don't have any of the Magnificent Seven really in my portfolio right now. but I'm going to teach. I'm going to start doing more. I'm going to, for this whole year, I haven't traded a lot on my own. I've been focusing so much on these yield max funds. I haven't done a lot of options trading myself. I've done a little bit. I got a couple on right now that I'm waiting to come off, um, that are performing pretty nice for me. So I'm pretty happy about those. But I want to do more of that. I just miss it. I like doing it. I'm pretty good at it, and I want to do it myself. I want to do some of that myself. So I'm going to get back into that in 2026. So that's what this was all about, where we were doing a lesson. I was teaching a lesson to another student on my options. So these are called cash secured puts. And then of course we got some options, some call options up here too. So this is kind of an advanced little strategy in here that we're playing with, kind of like a little, I don't know, almost it's kind of like an iron butterfly. All right, that we got on this one here. So this was a little strategy that we're running, but I want to do more of the style that we know that YieldMax does, where we buy low, sell high, and I'm going to teach that. How about we talk about that? Today's Monday. Wednesday's our next class, but that's a day trading class. So it would be Thursday, Wednesday, Thursday, it would be Friday. Maybe we ought to do a class tomorrow. We should do another class tomorrow, and I'll show you these option strategies because these are really fun. And I think you guys could do these. I mean, once you understand what's going on with the yield max funds and you're trading the yield max funds, you can understand. And I've taught you, we've talked ad nauseum about how they do what they do. You can do it yourself, and I can show it to you, and it's really cool. I like doing it myself, and it's high probability stuff. I mean, you can make good money doing it. You can lose money doing it too. You can lose money doing anything, but I show you this buy low, sell high using options, and it's a lot of fun. All right, I want to get back into doing some of that, a little bit more of that. So maybe we'll have class tomorrow too. 9 o'clock tomorrow, we'll do another class and we'll talk about options. But right now, I just wanted to talk to you a little bit about what I'm taking into the next year and my frustration with the ROCC and tax loss harvesting. So I'm taking AMD. I think I'm going to take AMD because I've got such good positions on them. All right. So AMD, that's my list right there. HOOY, NVDY, OARK, Palantir, which has been one of my best ones. I made $80,000 on Palantir. That's kind of been my saving grace right there. And then Snoy and Tesla and GDX, which is gold. All right. So AMD, HOY, NVIDIA, OARK, those are the ones that I've got left in my portfolio that I haven't washed out. These are the dividends that I've received off of just these. Now, of course, I had a whole bunch more other than this. I've closed them out, and these are the only ones I've got left in my portfolio. So this is just how these particular stocks. Now, I took the money and put it back into these stocks, okay? Except for what I took out. I've taken out cash withdrawal. I've taken out $112,000 in cash. And then I got $50,000 in cash just sitting there waiting to, I don't know what I'm going to do with it. It's just sitting there, 50,000. And then my current account balance is 551,000. Net value is 766,000 for a profit this year of 291,000. I'm $403,000 above my break even. So that's cool. That's why I get 61% annualized return. Now you'll notice that I don't have annualized return on each one of these individually. You'll notice in here that there is no percent gain calculated on each one of these. And the reason that is because this is all blended money. So you can't calculate it. That's what there's a little thing right here. It's not my job to show armchair analysts, YouTube armchair analysts, how they're doing their math wrong. And that's how they do their math wrong. What they'll do is they'll come in and they'll do a blended amount of money, because this 36,000, that includes part of this initial deposit, and it also includes a lot of dividends that I've put back in. So if you don't keep those two numbers separate, if you just merge them together, well, you can't do a percent return. Why? Because one is free money and you're making exponential compounded returns on it, and the other is seed money and it's making its own compounded returns. So if you merge those two together and then do a single annualized ROI percent gain, the number's wrong. right? It's not a true number. So you can't do that. And no real hedge fund does that, all right? Because they're blending their money all the time. They're always having a starting capital, and then they blend their money in. They take money, the profits, and they reinvest. Okay, oftentimes people will drip. I don't like dripping. I like you to be a little bit more strategic about putting your money in. That's what Portfolio Matrix is all about, helps us strategically put our money back into the markets. So we're not just dripping back in, because dripping is I proved that with my own accounting. Dripping's a terrible way of putting your money back in. Now we do it a lot in some of these other funds because the drip amount, the dividends are so tiny. They're like, why bother? Just put them back into the same thing you pulled them out of. But when you're doing these high yield funds, no, don't do that. Don't drip. All right. Be strategic about putting your money back in. It makes all the difference in the world. Okay. So I've got $36,000 of blended money in AMD. So I can't calculate a ROI off of that. The number would be wrong. The percent gain would be wrong. And I got 57,000 in Hoy. Now you can see, come down here, you can see the first quarter of 2025, I made $32,000 in dividends off of these stocks. Now I made more than that, but I put it back in. So 63,000 off of these particular stocks in the second quarter. And in the third quarter, I made $45,000. I had a good second quarter. Look at that, 63,000. And then I made 45,000 here. And then this last month, October, November, December, I did some, now if you remember, it was right here around September. I think it was September, October, right in here. I did my portfolio rebalancing. Remember that? So I did a portfolio rebalancing, and I made, I went from 45,000, I'm 90,000. So that was a good rebalance because I rebalanced mostly into these stocks that I'm in right now. So I made $90,000 in the fourth quarter. So for a grand total of $231,000 in dividends. So my dividends, $231,000, a monthly average of $23,000. So I make about 23 off of this particular account, this one account. I make about $23,000 a month. And that is pretty good money. I can live off that. All right. And that's just this one account. I got another account that does. And I don't keep the other account up in the spreadsheet because I don't have to. I mean, I do this one mostly for you guys, so you can see it. Because I have Portfolio Matrix now, I just do it in Portfolio Matrix, and I don't have to keep all these numbers. But I like to keep these numbers because, and I'll give you this spreadsheet. This spreadsheet's going to come out to you for anyone who, and I'm going to leave all my real numbers in here. I'm showing them to you. Why would I care if you have them? So this is my old one. And if you want to go back and have all the details, the other one, this one has all the details. It's just a different location that I put it. I hide it. Okay, this one is easier to see. So this is the old one. I stopped updating it and keeping it current. But you can see I had a little box down here for each one of the stocks. So each little box, so you can see all of the initial investment, right? The seed money. And then I broke out all of the initial investments. So this one you could actually, technically, you could go in and do what we were just talking about, where you could have a percent gain. And I do. It's right there. Total return 91%. This is 2%, 50%, 205% annualized return. So you can see that I got a return on this one. So because this one breaks out the reinvestment versus the initial seed, and then this one has all the dividends. So you can see each little box represents one stock, and it's a lot more detailed about how you can maintain all that. I just went over here to simplify it for tax purposes, and then I've just been keeping this one up. Again, I kind of get a little bit behind in these. It's a lot of work to do the spreadsheets. And now that I got Portfolio Matrix, I don't need to do all this work. So I simplified it, but the information is still there. You can see I just put it in the one cell. So see this cell right here, the invest amount, I just add it right here in the cell. And I just keep adding them on. Whenever I get a dividend, or I reinvest some money, I just add it right there in the cell. So for those of you who know Excel, you can see how I'm doing that. So you'll see all these are calculations, but then I just take these numbers. So that's just my reinvested money. And then each one of these, you can see I do the same thing down here in a cell. So NVIDIA, October, 6,600. Well, it's just, those are all of my dividends that I got right there. So I don't list them out in this spreadsheet like I do in this one. They're not, you can't go look at them like this. And the reason oh crap, now I hate it when it does that. I didn't want to do that. How do I get off of this? Oh, no. I hate Excel for that. You try and point something out and then it screws everything up. Okay, kind of back. All right. So anyway, that's my point that I was trying to make, that this spreadsheet has all the same information. It's just built into the cell, because we went to weekly dividends, and it's just too hard to, I mean, the little spreadsheet would have got 10 miles long. You know, we went from having 12 cells to 52 cells for each one. It started to get ridiculous. So now I just went to a simpler spreadsheet. So I'm going to send this spreadsheet out to everybody who subscribes to Pit News Magazine, and you're going to get this in your in your email. The January issue of Pit News Magazine is dropping out, coming in what? I guess in like Wednesday or something. When's the 1st? Or is it Thursday? Thursday. So on Thursday, you'll get the new Pit News Magazine for January, which is really cool. It's turned out really nice. There's some great stuff in there, especially if you're interested in trading PLTY. The magazine kind of focuses on PLTY. This January issue has a lot of information about PLTY, what it does, what kind of money it's making, why it makes the money. It's deep dive into PLTY because it's been such a good stock. We wanted to focus on it for 2026 and see what we think going forward. And then I'll include this new spreadsheet, all right? Because I think I've got it pretty much where I want it for the way it's working right now. And you guys can have this, all right? I put notes in here so you can see where I write the notes and kind of try to explain a little bit. Like right here, this has a nice note on it explaining to you why we do what we do. So, all right, so there's that. Now I want to come over and I want to look at the other markets. I want to look at these markets and see if there's, because we got some money sitting on the sideline. We're going to have $10,000 come in today on our distributions. Plus I have $50,000 sitting in cash. So I got about $60,000 that I've got to figure out what I'm going to do with. All right, whether I put it back in, I've got this in this spreadsheet. You can see down here, I've got 2026 all ready to go. And so my first January distributions, they'll come in. Well, I don't know what they're going to do because they got all screwed up because of the Christmas holiday. And now we got New Year's holiday. I don't know. That's why we're getting dividends tonight instead of last Friday. So I don't know how that's going to work. There's still going to be December dividends. So this number is going to go up by another 10,000. That's going to probably break them. No, probably not, because half of that goes to my, not quite half of it. Probably about 30% of it goes to my, yeah, it's not going to break 1,000. That would have been cool. 100,000 in 1 month. Wow. That would have been a lot of money in 1 month, $100,000. But fourth quarters are not in a month. That would have been a quarter. So $100,000 in 1 quarter. Or my last third quarter was 45,000, and then 63,000 and 32,000. This quarter is going to be almost $100,000 in the third quarter. So that's how this is all going to work out. So I want to go over and take a look at the market. Uh-oh, what did I just do? Go over and take a look at the market. But we want to look at AMD, HOI, NVIDIA, OARK, PLT, SNOI, and let's just start off with AMD. I've not got a good enough memory to remember all those. I think they're already over here, though. Real money. Okay. AMD. So this is the one that we've got right now. Now, my average price on AMD, this is how I do it. When I do it, I want to know what my average cost is, where I'm at, and whether I can put more money into this one or not. And so when I'm in Portfolio Matrix, I list Portfolio Matrix. I list in there which ones I have, which ones are below my average cost, and then those are the ones that I'll create a little portfolio for, and then I'll have Portfolio Matrix tell me which one to put the money into. So my average cost is $219. Oh, on AMD, $219. So that's my average cost right there. I'm right at the average. So if it comes down a little bit, I can start adding more money into AMD. It wouldn't do any good right now. I mean, the average cost, I want to bring it down here. So we're right at the red line right now. The 200 period moving average is down here. I think we'll get another drop. I think we're going to get a little ABC pattern off of here. I think it's going to come out. It's going sideways right now. I don't know. I think we'll get a drop. Give me an opportunity to put some more money in down in here. So that's what I'm looking at on AMD. That's for me. So you guys do the same thing. You set up yours, find out where your average price is, and then calculate off of. Now I use I like to use Donchian channel only because it's the same thing. I've just got mine set up for being a Fibonacci ruler. So it's just coming off of the lows and highs of these markets. And that's my Fibonacci projections and retracements. That's all it is. It's just a lazy man's Fibonacci ruler. So I put the period to 100. That's all I'm doing. All right. Somebody asked me, I had my offset set to 2 up here, and they're like, well, why do you offset it? I don't. It's just goofing off. Just an offset. Just put it at 0. It's perfectly fine. But this is the period of 100. So it's looking back 100 bars, high and low, and it's just telling you where the middle is. So it's roughly a 50% retracement. And then a Fibonacci ruler is just basically the same thing, but it has 61, 50, and 38.2% on there as well to give you the Fibonacci sweet spot. So we're kind of right dead center of that Fibonacci sweet spot right now between 38.2 and 61.8. Yes, I've got it upside down, but we're going down. So, yeah, I got it upside down. So we could switch that. I don't know if anybody cares. I care. I'm just one of those guys that cares. I want it to be this way. All right, so there we go. So now we're right there, 38.2 pullback, 50%, 61.8. So we almost touched the 61.8 right there. So the thing is, we're just dead center right now. And unfortunately, my average entry is right there. So if we went and looked at my spreadsheet, we could see AMD, I'm only up $1,500. Either the market needs to rise or I need more dividends. Right? Don't really care if the market rises because they're just going to keep giving me my dividends. My dividends will stack up. What we don't want is the market to go down. If the market goes down, well, then this number here falls. And we don't want those numbers to fall. We want these numbers to stay big, right? Even though these can cover it, see, we're almost, I mean, this is my yield right here. So 3,200 ahead of the 17. So it's gone down 17, but I've received 3,200 in dividends. So I'm up $1,500. So that's why you work on your dollar cost average and try and make sure that when you build your portfolio, you try and build a portfolio that doesn't have $110,000 in losses, right? So try not to buy high and then have the market flush and then have to have the yield cover your losses. So I've received $242,000 in distributions, but I've lost $110,000 in buying high and having the market flush out from under me. So now I'm only up 131,000. Like, well, nobody's going to cry tears over somebody who just made $131,000. Okay, well, don't cry tears for yourself then when you lose 110 but cover at 242 and then you have 131,000. This is what we're trying to perfect over here a little bit. Now, oftentimes we'll say, well, it doesn't really matter what's going on over here because you're never going to sell them, but you really are because you're going to tax loss harvest them. So you want to do the best you can in the NAV so that your yield doesn't have to always just cover the losses in the NAV and you can still make a bigger amount of money. So that's the goal for 2026. I'm going to focus more on trying to do a better job of having a better NAV. I want to trade better. All right. So I want to dollar cost average, pull my average. I need to bring that yellow line down here as low as I can get it so that I can have a better NAV return. All right. That's the point I'm trying to make. So now we're going to come in here to AMDY. This is just the yield max fund. This is where you put your money, but you don't actually look at that one. This is the one you care about right here, right? Actually, that's not right. I'm doing that backwards. AMDY. I got distracted and did something wrong here. I just taught you the wrong thing. I do have AMD, and that's my average price, but that's not my average price on AMDY. So AMDY, oh, I got a $375 dividend coming in today on that one. My average price on AMDY is 39.24. So 39.24. That's the exact same concept. I was just on the wrong chart. 39.24. 39.24. Right there's my average price. See, I'm about the same. So it's still, but I don't want to invest until I get down under. Well, I can do it anytime. AMDY. Anytime the market's underneath that yellow line, I can put more money in there. All right. ARKK is the underlying. Our position is in OARK. So OARK. Let's go see what my average price on OARK is. Is it in there? No. OARK. My average price is 41.34. Let's move these down so we can see better. 41.34. So if I'm at 41.34, are you guys following along and doing this in your own accounts? Okay, so that's the whole idea. You're supposed to have your charts up, and you're supposed to be doing what I'm doing, right? So this is my average price here. Oh, look, this is OARK, and it's still flushing down a little bit. So we could put more money in here, and that would pull our average cost down. But right now, OARKK, do we feel like, yeah, I think we got some more downside potential. So I don't want to put money in there. Try and anticipate that the market's going to fall. And I want to buy it when it's coming down. Where's our Fibonacci projection tool? Right there. So A, B, C. So if this market keeps coming down, we got some more downside potential. We got a 200 period moving average right here, and it looks like it's still falling. So I don't want to buy into it yet. I don't want to put my money in. Yes, but Lan, if you put your money in now, you'll get your dividends. True. But all my dividends are going to be doing is paying for the loss on the NAV. I mean, eventually they might catch up and surpass it, which on my spreadsheet they have, and that's been the logic that we've been thinking about before, right? It's like, well, it doesn't matter. You're getting more money. You're getting more money on the yield by having your money in there than you're losing on the NAV. So get your money in there. It doesn't matter what the NAV is. Put your money in there so that you can get your yield. It depends on how fast the market falls. If the market falls faster than what your yield can pick up, then it's not helping. I don't know. That's the argument. I don't know. There's no right answer. It's just different. Is the right answer to put your, well, it depends on what the market's going to do, and nobody knows what the market's going to do. We don't know what the market's going to do. If it falls really hard, it would have been better to keep your money off. If it falls slowly, then it's better to put your money in. Even though your dollar cost average is higher, doesn't matter. You're still making more money on the yield than you're losing on the NAV. There's no right answer. You're just going to have to do what you do and take the outcome. If we knew the right answer, we'd all be rich beyond our wildest dreams. We wouldn't, I mean, but we don't know the right answer. The right answer is, do you think the market's going to fall faster than what the yield can outperform? If it does, you don't want to put your money in. If you think your yield is going to outperform and they're not giving you an ROC, see, there's another variable in our mathematical model that we don't know. It's an unknown variable. We don't know how much they're going to give us back on ROC. How much of that yield that they give you to cover the losses, or they give you the yield, how much of it's ROC? We don't know. Don't know until the end of the year when they calculate it all up and give you one little 1099. That's the frustrating thing that I'm going through right now. I want to know what ROC is on a dividend by dividend basis. If they give me what's this one set at? $289 on OARK. How much of that is ROC? I don't know. I don't know if any of it is. They don't tell you. I want to know why they don't tell us. How come we don't know? All right, so let's go look at the next one. So the next one is now Bitto I don't have. See, I had the Bitto is one that I Bitto is one that I tax loss harvested because it was a stupid Bitcoin that went down. And I had like $250,000 in these stupid Bitcoin funds, and I lost $100,000 off of this stupid Bitcoin drop. Now, it was a $250,000 drop. So I lost 250,000. But because of the dividends, I kept getting all these dividends to help cover it. So I was just like, well, if it'll just stop going down, my dividends will cover it. But it kept going down faster than my dividends could keep up with it. And so I ended up slowly losing money, just bleeding out over the whole 3 month, the last 3 months, just bleeding out, because the dividends couldn't keep up with the NAV decay. The loss of the Bitcoin just went straight down. So I lost $100,000. Everybody else lost 250,000. I mean, you could put it that way. You want to look on the bright side, right? Everybody else who had the same holdings I did that weren't receiving the high dividends, they lost 250,000. But I lost 100,000 because I had dividends covering all the losses, covering the loss. So it wasn't as bad. And even with that nasty loss, I still ended up with 61% annualized return. And, I had $391,000 in profit. I mean, you could look at it like that. I had 391. Now I only have 291. No, I know. Nobody's going to cry tears over somebody who's making $291,000 in a year. But when you had 391,000, come on, play something for me better than just this little violin. Can't feel so bad. All right. That's a lot of money. Okay, so let's go on to the next one. GDXY. Now this is, oh, look at that. That's gold. GDXY, of course, it flushed. Probably because what's gold doing? Gold's flushed. Okay. Now I bought this back around December 1st, the 1st of December. So it rode up a little bit, made a couple of small dividends, not much to speak of. And now gold's flushing down again. So it'll give us an opportunity to get some more at a lower price, I guess. Just look on the bright side, right? So gold's been going up for the whole time I've owned it. And then now it all lost everything that I made in 1 month, in 1 day. It might be tax loss harvesters, selling out. I don't know why the market flushed like that. At the end of the year, it's probably some tax loss harvesting going on. So in 30 days, gold will probably turn and start to go back up. They got to stay out of gold for 30 days if they tax loss harvest it. If that's what that is, if that's tax loss harvesting, they're going to have to sit out for 30 days before they can put it back in. And gold bugs, they love their gold. So if they're tax loss harvesting, they'll put it back in. You wait and see. In 30 days, they'll start putting it back in. Will they put it all back in at once? I don't think they'll just like everybody who took it out here, put it all back in here. I don't think that'll happen, but I think that will eventually go back into the market. So that's gold. I'm not going to worry about that. It's such a tiny little piece and I don't have a very good position on it anyway. So let's look at Hood. This is a good one. I've got a lot of money in Hood. So Alt tab, let's go. So Hood, oh, I don't have that much, 57,000. That's still a lot of money. 57,000 into Hood, which is HOY. What's my profit on that? Am I sitting on any profit? I don't think I am. I'm down, see? Look, the NAV's down 11. My yield is 10. So everybody else who had the same position I had, they're down 11,000. But because I had dividends coming in, it covered 10,000 of them, so I'm only down 1,800. And the dividends that come in every month on that are about 1,500. December, I'm up 2,200. 15. Ooh, October was 4,000. I don't know why. 1,500. Let's see. So I'm only down one dividend. 1 month of dividends. It's 4 dividends now, but 1 month of dividends. So let's go look at Hood. Hood, where do we think it's going from here? Well, it's below the red line. 200 period moving average down here. Let's shrink this down so it's not so ugly. So this is the topping pattern. This is the, look at this. This is what we're looking at right here. That's our map. It's following it like a train on rails. Come on. How come I can't shrink that? I hate this Windows thing. Sometimes it's so sensitive. All right. So there we go. So this is our accumulation stage down in here. Right here. And then we went up through this big long uptrend. Boop, 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 boop. Had a couple little, this is strong, man, look at that. And then this is getting a little topping formation up in here. That's this right here. Now, what are we looking forward to? Getting a little rally, and then we're getting this little pull. We're going to go through this, and we're going to get a little drop out the bottom, and we'll go through another accumulation stage down here. I think I'm bullish on this market. So if it's bullish, then this is what it looks like. If you're not bullish, then this is what it looks like. Okay, see the difference between these two? Can you see the difference between those two? If you're bullish on the market, then we anticipate that the pullback is only halfway. See, from bottom to top, that's about a 50% retracement. If you're bearish on the market, then we expect it to come back 100% all the way back down into the bottom before it rallies. So you might get a full pullback, or you can even get, this would be a bear market up in here. So if we're anticipating a possible bear market, this is what your little map would look like. But if you're bullish on the market, then we only expect it to come back halfway and then start to rally back out. All right, so I got two maps here. You see me pull them up different times depending on which markets I'm looking at. Am I bearish on the market? Then I pull up this one. If I'm bullish on the market, then I pull up this one. All right. So I'm bullish on this market. So I think we're only going to get a halfway pullback. I think it'll come back into the Fibonacci sweet spot from the overall longer term trend. So the downside to this market is possibly, so I could probably, based on that, I could probably tax loss harvest this one. Oh, there's not much to tax loss harvest. Well, there is. How much does the tax loss harvest? I could tax loss harvest $11,000, but I don't know if I need it. But then I'd miss out on my dividends for 30 days. So I could miss out on a possible, look, this thing's been returning. Hoy's been returning $2,200, $1,500, $4,000 in the month of October. I don't know why. I think that's when we switched over from monthlies to weeklies and they reconciled. And I think they're doing a little reconciliation here too. That's why we're up at 2,200. And we're going to get another, what do we say, another 500 or 400, 300, 200, something. A couple $100 in there. So I could tax loss harvest that one, but then I couldn't get back into it for 30 days. But that might not be a bad thing because this projection says that for the next 30 days, this is going to probably be a down month. Right? So we might want to tax loss harvest Hoy. I could sell out of that one and not feel bad because it's not going to go shooting up. Maybe. But I have to stay out of it for 30 days. What's my average cost on it? What's my average cost on that one? Are you guys doing this for yourselves? I hope you guys are doing all this for yourselves. Oh, I'm getting $632 coming in on this one today. So that will be 632 added to 2,002. That's going to take it over $3,000. Just right there, close to $3,000. See, and if I'm out for, so if I could make on average, but I think that's a little bit bigger. So let's just say 2,000. I would lose. I got to be out for a month. Well, I'd lose 2,000 because that's what 2,500. Let's say $2,500. I'd lose $2,500. Where's $2,500 to break even? $2,500 is what I would lose. And if I have HOOY, $2,500, come on. What's my average price on this thing? It's 61.84. Ooh. 61. I'm clear up here. 61.84. Well, that would give me the opportunity to bring that dollar cost average down, but it's going to cost me $2,000. And if I got $11,000 out of it, well, if I'm in a 25%, 35% tax bracket, 35%, it would be well worth it, wouldn't it, to sacrifice the dividends? Takes the tax loss harvest. It's going to be about a wash. Make the money in the market or give it to the government. Either way, I gotta lose it in a downtrend, or pay it to the government. I'll probably tax loss harvest that one because I think that the hood's going to come down a little bit. Might not come down. $2,500 for 100 shares. How many do I have? Oh, I got 900. Let's come in here and go to the preferences. And I go 900. So if I got 900 shares and I lose, $2,000, it's only to right here. Ooh, that's not very much. I could lose $2,000 if that market just comes down and touches that, just about that yellow line right there. And that would be this market coming down into the Fibonacci sweet spot. I think it's going to do it. What do you guys think? You think it's going to come down into the Fibonacci sweet spot? Because if it does, that'd give me the opportunity, that would give us, you guys doing this too, the opportunity to get in at a lower price and save our taxes. And if it just keeps falling, the dividends were just going to do nothing but cover the NAV loss. It would be if we didn't think the market was going to fall, if we just thought it was going to stay right up in here where it's at, we'd be better off just staying in the market. But if we think it's going to fall, I could tax loss harvest that, save myself about $3,000 in taxes, and then get back into hood at a lower price and start from a better location. Thing is, if it started to rally and go hard, I can't get back in for 30 days. I'm locked out. If I sell that thing off, I'm locked out for 30 days. That means for all of January, I'd have to be out of the market. That's my dilemma. Do I know the right answer? I don't know the right answer. I just told you all the variables. Now you have to decide what you think the market's going to do. That's why predicting market direction is the key to the whole thing. And that's the hardest part, right? Nobody knows what the market's going to do. That's why we do our very best technical analysis. That's why it's important to learn about technical analysis. That's why you need to go get my book. Sell your book, Len. Go get my book. It's on Amazon. Teaches you technical analysis, teaches you how to read these charts so you can make these decisions on whether you think the market's going to go up and down, so that you can decide whether you want to tax loss harvest or not, right? I mean, these are all the things you do. We call it work for a reason. It's not fun. You have to make decisions. You want to make the very best scientifically wild ass guess that you possibly can, because that's all it is. It's just a wild ass guess. Nobody knows what the market's going to do. Where's Claire been? Haven't seen her forever. She's been working behind the scenes. You know Claire. She's a little moody. Bet you couldn't guess that. She sent me some more AI pictures. I'm not going to show them to you guys because she's just been playing with AI. It's not an ad or anything. It's just she sent me some silly little cartoons and stuff for Christmas. But that's all she's been doing. Can't say much about her. She hasn't even done she's only done like one podcast here in the last little while. She's been pretty quiet. She's working on Pit News Magazine. Not very hard. I had to do most of it this month. Everybody kind of went silent in the month of December. Left it all on Land's shoulders to do everything. So hopefully you enjoy the January issue because it's mostly me. She helped a little bit. All right, guys, I guess that's all I got for you today. I'm just going to keep doing the same thing over and over and over again on the rest of them. You guys have kind of got the same thing happen. Misty just keeps falling. I got my money out of there, so I don't really have much to say about Misty. I'm not in it. I'm tax loss harvesting that one. NVIDIA, we're going to do the same thing. We're going to have to just calculate our tax loss harvest, find out if we want to harvest them or not. I had already done all this at one point a couple weeks ago and had decided that this is the ones I was going to carry through. But I'm doing here this last week, I'm kind of doing my last final hurrah to find out which ones of these I'm going to take off. And I'm thinking Hoy's going to come off. Tax loss harvest, that $12,000 right there. And because I'm going to have to pay taxes on the $10,000. And if Hoy's going to go down for the next 30 days, which it looks like it's going to do, I might as well take that $12,000 off and not pay taxes on the well, see, there's only a $2,000. Well, I'm going to have to pay taxes on this one because I'm not taking that off. So I have to pay taxes on $10,000 when I don't need to. I can take it off. Same here. I got $25,000 in NVIDIA. I could take that $25,000 off and not have to pay taxes on $37,000. See, I got $100,000. I could just take all of these off, just wipe them all out, and not have to pay taxes on $110,000. But I don't know if I need to do that because I don't know what ROC is. I don't know what ROC is. I don't know how much of that capital they gave back to me. If I just took it all off, then I end up with more of a tax deduction than I need. And then I can't write it off on my taxes because I can only write off $3,000. I don't know where I sit. It's frustrating. So I'm going to do some more research and find out how come we don't know what ROC is, how much ROC we've got in our account before tax loss harvesting. I'm going to contact YieldMax. I don't know how to contact them. I've tried to contact them a number of times. They don't ever answer. They're just a great, big, huge, giant corporation that never talks to you because they're not the front end. They're the back end. So I don't know who you talk to. Can't get a hold of brokerage firm because they don't know. They don't talk to you. Oh, they don't give us the information. We don't know. How are we supposed to tell you? I don't know. I don't know the answers to some of these things. I'm going to do a little bit more research and I'll let you know. Kirk says he's been following the UBI strategy. I don't know some of these fringe answers. I'm still trying to work them out. I wish it was just as simple as a little math formula, but at this point it's not. These things are also new. I don't know if they know. I don't know if they know. All right, guys. Let's not let's pull up this little thing here. We'll play a little bit just for fun before we let you go. Let's remember to get Pit News Magazine. There's this little square in the middle, this funny little square. Scan it with your phone if you don't have Pit News Magazine so you can get this spreadsheet. All right, this is how you get Pit News Magazine.
Ready to level up your news game? Welcome to Pit News Magazine, where stories come alive. Read it, hear it, or watch it in our YouTube classroom. Right now, get your first 2 issues for just $1. Yep, only $1. Don't love it? Cancel anytime before the $39 yearly fee kicks in. Try it out, risk-free. Satisfaction guaranteed, or your money back. Visit pitnews.com. That's pitnews.com. Pit News Magazine. News your way.
All right, there's Pit News Magazine. So if you get that, subscribe to Pit News Magazine if you haven't. You're going to get this spreadsheet. I'm going to give you this spreadsheet, and it'll come with this one here. It'll come with the older one, which is more detailed. You can put your own information into that one. This is my old traditional IRA, and it's even older. But it's a simpler version than this one. This one's got pretty crazy. This is a little bit simpler version. So you're going to get this spreadsheet. You can have it when you have subscribed to Pitt News Magazine. It'll be in the email, link to it in the email. And then for those of you who are asking about Claire, I'll run her ad. I don't know what. I'll run her ad so you can at least, there you go.
Hey, Claire here. Guess what? Mr. Turner handed me the mic. I've now got my very own podcast, Pitt News on Air, your new weekly hit from Pitt News Magazine. Join me every Wednesday for stories, interviews, and a little behind-the-scenes scoop. We're live on Spotify, and yep, now on Apple Podcasts too. Visit pittnews.com to follow. Come hang out with me and the gang. We're all there. Jake and Lena, of course, Lan Turner, David Duty, Dr. Scott Brown, Jordan Black, and even Aiden shows up on occasion. We're having a world of fun. Don't miss out. Pitt News on Air. Because news should never be boring. It's where your trading friends are. Follow us wherever you get your podcasts.
All right. Yeah, we haven't seen a lot of Claire lately. She works out of Las Vegas, so we don't see a lot of her. She's got an article in Pitt News Magazine, January issue, so you can go read her article. All right, guys, that's all I got for you except for this one. One last thing.
Okay, this is the software I use. It's called Track and Trade. They've got two versions, one for stocks, one for futures. This is the website, track, the letter N, trade.com. This is where you download a free 2-week trial. No credit card required. Okay, go download your copy, then come back here, follow along, and I'll show you all my settings.
All right, guys, that's it. That's all I got for you today. Have a good day, and let's come back here, and I want to do the options thing. So we'll talk about options tomorrow morning. 9. We'll do the same thing. 9 o'clock. I'm going to be sitting here anyway, and I'm going to be doing it anyway. So I might as well just flip on the camera and let you guys watch along with me, because it's just what I do every morning anyway. So you guys come and hang out with me if you want. That's how this thing works. I'm just hanging out, doing my thing, because this is what I do for a living. I just trade these markets. That's all I do. And so if you guys want to hang out and see how I do it, then I'll show you. And I'm going to get into the options a little bit more. I kind of didn't do so many of them this year. I was kind of more focused on the UBI stuff. So I want to get back into options this year. Do a little bit more option strategy. I'm going to show you the strategy that I'm going to run, buy low, sell high. And I'm going to show you how to do that with options. All right, guys, we'll see you tomorrow morning, 9 o'clock, bright and early. Take care.
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pitt News Magazine.
Oh yeah, definitely subscribe to Pitt News Magazine. You'll thank us later.